So dear students, in previous discussion we discussed about the time value of money. So in this video we want to see about the payback analysis and depreciation. So what is simple payback? So simple payback is defined as the investment, total investment divided by the annual savings after taxes. And similarly the payback period we already discussed. What is meant by payback period? That is the duration required to recover the capital amount per investment is called payback period. And we have one formula for the payback period also. So the formula for the payback period is net investment or capital cost divided by the net annual cash flow or net annual savings. And if the sum of the difference between the capital cash flow to the overall cost is positive, implies that the project will be acceptable. Else the project will be not acceptable, that means rejected. And next, advantages of this payback analysis is can be able to judge availability of financial resources in future and helps to achieve successful investments for a project. And what is the disadvantage? The time value of money is not directly considered. Effect of cash flow after the payback is not considered. So that is the disadvantages. So why we go for the payback analysis means for achieving the successful investment, we can prefer for the payback analysis. But here, direct time value of money we are not considering, and effect of cash flow after the payback is not also considered. So after a certain time, the equipment is to be replaced because of the physical and functional reasons. So physical means the plant has worn out and become unfit for the further use. And the functional means capacity of the plant become inadequate due to the load growth, and plant has become obsolete due to the new technical improvement. So because of these two reasons, the rate of that plant will be depreciated. That amount is to be called as depreciation. So in the previous we discussed about the payback analysis. Now our topic is depreciation. So for the depreciation we have so many methods, those 5 methods. Those are nothing but straight line depreciation and sum of years digits depreciation and declining balance depreciation and diminishing value method and sinking fund depreciation. So under that first one, straight line depreciation. So there is a reduction in value of the equipment and other property of the plant every year due to the depreciation. So in this type of depreciation, every year the value of the equipment will be definitely reduced. A constant depreciation charge is made every year on the basis of the total depreciation and useful life of the property. So in this method, we can charge the constant depreciation amount for every year on the basis of the total depreciation and the useful life of the property. So the annual depreciation charge equals to the total depreciation divided by the useful life of the property. That is one formula. So annual depreciation is equal to total depreciation divided by the useful life of the that particular equipment. So for example, if the initial cost of the equipment is 1 lakh, 1 lakh 1 lakh and its scrap value is 10,000. So what is the depreciation? The value of the equipment will be depreciated to 1 lakh to 10,000. So the depreciation is 90,000. So the useful life is 20 years. So the annual depreciation we call as 90,000 divided by 20. So for every year 4,500 amount will be depreciated in the by using the straight line method. And by seeing this calculation, we can form one formula. So that formula is nothing but annual depreciation charge is equal to P minus S by N, where P is equal to initial cost of the equipment and N is equal to useful life of the equipment in years and S equal to scrap value or salvage value after the useful life of the plant. So the drawbacks for the straight line depreciation is assumptions of the constant depreciation charge is not correct. So here we consider for every year there will be some constant depreciation will be considered, but we may not tell for every year the depreciation will occur or not. So it does not account for the interest which may be drawn during the accumulation. So it cannot account the interest also. So these two are the drawbacks of the straight line depreciation. And next, sum of years digits depreciation. So in this method, depreciation is determined by finding the sum of the digits using the following formula. So the formula for the sum of digits is capital N, that equal to n into n plus 1 by 2, where n equal to life of the equipment, that is the useful life of the equipment. So by using the useful life of the equipment, first we find the n, and by using that n, we can find the depreciation for every year. For the first year, formula is one formula, that is n by n into p minus l. And for the second year, n minus 1 by n into p minus l. And for the third year, n minus 2 by n into p minus l, where n is the useful life of the equipment, and capital N is the sum of the digits, and p is the total cost of the equipment, and l is the salvage value or scrap value. And next, third one is declining balance depreciation. So depreciation charges are larger in the earlier stage. So in this method, depreciation rate can be re-established. So for that, we use one formula. That formula is nothing but d is equal to 1 minus l by p whole to the power of 1 by n. So here capital not capital N. This is the small n. That means useful life of the equipment. So from this, the annual depreciation rate equal to salvage value or scrap value L, and P is the initial investment, and small n is the duration or useful life. And fourth method for the depreciation is diminishing value depreciation. So similar to the declining balance method, depreciation charge is fixed for every year, more rational than straight line method. So depreciation value, we have one formula, and depreciation after n years, we have the another formula. The formula for the depreciation value, d is equal to 1 minus l by p whole to the power of 1 by n, and the depreciation after n years, p into 1 minus d whole to the power of n. So by using the straight line method, we have the constant depreciation value, and by using the diminishing value method, we have for every year the decreased depreciation value. And the last one and very wonderful method is sinking fund depreciation. So here what we do means, the fixed depreciation charge is made every year and the interest compounded on it annually. So here we have one depreciation, and in addition to the depreciation, we consider the extra depreciation, and that will be considered and that will be credited in the depreciation account. So for the depreciation account, it will be credited, and that is not a depreciation, but we consider that as the depreciation, and that fund will be credited in the depreciation account. So for that amount, interest is also considered. So depreciation charge implies cost of replacement of the equipment after its useful life. So this fund every year, which will be credited to our depreciation account, and which can be get the interest for every year, this will be used at the at the ending time of the equipment for the cost of replacement. That means to replace that scrap value with new one, this amount will be used. So depreciation charge is equal to total annual investment plus interest accumulations. Sinking fund method. Total fund must be equal to the cost of the replacement of the equipment. So cost of the replacement equal to P minus S, where P is the initial investment or capital, and S is the salvage value or scrap value. So the total sinking fund equal to Q into 1 plus R whole to the power of N minus 1 divided by R. According to the sinking fund method, total fund equals to the cost of replacement. So equate A and B. P minus S is equal to some Q into 1 minus R whole to the power of N minus 1 by R. So sinking fund Q is equal to, by making all this to the P minus S side, then we get one formula. So this formula can be used for finding the sinking fund method and total depreciation value for the sinking fund depreciation method. So here also P is the initial value of the equipment, and N is the useful life of the equipment, and S is the scrap value of the equipment, and R is the annual rate of interest expressed as a decimal number. And advantages of the sinking fund method: interest is considered and economically sound, and provide the cash for replacement, and enabling drawing up of balance sheet. And what is the disadvantages? Calculation is difficult and accounting is rather difficult. So this is about the various depreciation methods. What are the various depreciation methods? First one is the straight line method, and second one is the year of sum of year digit methods, and third one is the declining balance depreciation method, and the fourth one is the diminishing value depreciation method, and fifth one is the sinking fund depreciation method. So in the next class we will see about the tax and tax credits. Thank you.